Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, today, guys, I'm thrilled to welcome our guest for today's show, Carly Iacono. Carly is a senior vice president in CBRE's Capital Markets Investment Properties Group, specializing in the acquisition and disposition of net lease assets and large portfolio transactions nationwide. Now, she's also a recognized expert in corporate sale leaseback structuring, multi-tenant retail investments, and development advisory, where she guides both institutional and private clients through complex deals. Additionally, she's the host of the popular Commercial Real Estate Now podcast, where she shares expert insights on the news and trends shaping the commercial real estate landscape. And so on today's show, we're going to dive deep into corporate sale leasebacks. Talk about the what, the how, and the why, and explore how this powerful tool can benefit both companies and investors alike. And so, Carly, welcome to the show. It's a pleasure to have you here.
Thank you so much, Kevin. Really appreciate it. Great to see you.
Yeah, absolutely excited to have you here and to talk shop. But I guess before we do that, before we get into the nitty gritty of it all, I know that we're going to talk about corporate sale leaseback strategy and just how that plays into both sides of the equation, both company and also the investor. But before we go down to that rabbit hole, let's back it up a little bit. I'll give you the brief introduction there, but maybe you'll take a few minutes for those that aren't familiar with you and tell us a little more about yourself and how you found your way into the world of commercial real estate.
Oh, that is a long and twisted journey, but I've been in the industry for a long time and doing exactly what I do now for, gosh, probably 15 years. So lots of experience working with everyone from institutional clients to private clients buying their first deal in commercial real estate. We are based in Northern New Jersey, outside New York, but transact in all 50 states. So good depth of experience and happy to share whatever I can with you on the show today.
Okay, no, fantastic. So I know we're gonna have a fun conversation around corporate sale leaseback strategies, and let's start with laying the foundation here. I guess for those that aren't familiar with it, I've never heard of it. Maybe I guess what exactly is a corporate sale leaseback, and how does it work?
At its most basic form, a sale leaseback is when a company operates a business and owns the real estate where they operate the business, and they choose to sell the real estate and become a tenant. So you are selling the real estate and then
Okay.
leasing it back, right? That's what a sale leaseback is. Now, what's interesting is virtually no companies own their own real estate anymore. And this is from Walmart to McDonald's to large
Mhm.
corporate headquarters, right? Single tenant buildings that could be hundreds of thousands of square feet. So the sale leaseback is a tool that companies use for a lot of different reasons. And we'll go through many of those today, I'm sure, to monetize the real estate and unlock value that otherwise is kind of held hostage throughout their tenancy.
Yeah, well, how about we start there? Because I think that that's a good place to just really. I'm sure that immediately folks are like, "Why?" In fact, I'd referenced
Yeah.
a conversation I had yesterday with a good friend of mine who works for a large medical group, and they are talking about in quite a number of buildings, and he was a little in awe that they have decided, or at least in discussions, to sell
Sure.
quite a bit of their real estate, and probably to the tune of 50 or $60 million worth of real estate, and he just didn't understand why. He was very confused about it. So how about let's go through some of the more common reasons as to why a company might consider doing this.
Absolutely. So first, there are tremendous tax benefits. Obviously, I'm not a CPA, so all tax comments have to come with that caveat, but a lease becomes an operating expense. So you can write off your rent completely as an expense. Whereas when you own a property, you're really limited to interest rate or interest expense deductions and depreciation. So you
Mhm.
don't get the full tax shelter from the expense that you do if you have an operating lease. So that's number one. Number two, you can usually get 100% of the value of your property. So it's a much more effective way to access capital than if you were going to, let's say, refi and pull money out. You would not be getting the same proceeds as if you refied that you would under a sale leaseback. So you can
Hmm.
access a lot more capital at typically more favorable rates than a typical bank loan. Now, number three, it's a great tool to fuel growth. So if you have a practice that you want to open another location or you wanted to expand your business in some way, again, this is an off balance sheet transaction that allows you to access capital and expand under very favorable terms. So it's really a combination of all of these different reasons. You have long-term tax benefits, you have access to capital at more affordable rates, and then you have the freedom to expand your business, which hopefully is where you make most of your money anyway. And that
Right.
capital is going to be returning more than it would in, let's just say, a real estate hold, which will appreciate hopefully somewhat over time, but not theoretically at the same rate of return that you could get from operating your core business.
Yeah. Are there particular industries that it's more common to see this in than others?
A really popular one actually is manufacturing and
Hmm.
industrial sites, but it's pretty widespread. Spread. We've done medical sale leasebacks, we've done corporate headquarter sale leasebacks, we've done operational real estate, like the industrial example I just gave you. So I think the where you see it more is where the company starts by owning their real estate. On the flip side, a lot of retail companies don't ever own their real estate. So if you don't own it
Yeah.
in the first place, then you can't do a sale leaseback. So that's
Hmm.
why you don't hear as many of the retail sale leasebacks because they didn't own their real estate to begin with. Airports, airport hangars, I mean, you name it. I feel like we've structured through the years.
Yeah. Yeah. Are there any potential, I guess, drawbacks or maybe even trade-offs, from a seller's perspective that they, I guess should be aware of, like things that they might not be thinking of before entering in or considering one of these types of agreements?
Of course, so many. And the structure of the lease is crucial. So if you're
Okay.
looking at this from the occupier standpoint, and by occupier, I mean the company that is operating the business and selling the real estate. If you are the occupier, you have to be so very careful with the lease provisions that you are agreeing to in your sale leaseback. One, you want to make sure the term is long enough, including a base term and options, that you have full control of that property for 50, 60 years, as long as you
Mhm.
think you might need it. So be very careful with your term. Two, market rent. You don't want to agree to rent that is not sustainable for your business, right? This is an expense that you are agreeing to take on for the long term. So you need to make sure that it is comfortable for your business to carry. Rent increases is another one. All leases will have structured rent increases. Those could be 2% a year. They could be 10% every five, 3% a year. It depends on the industry. And you want to make sure, again, that your rent with those increases factored in is sustainable. And then there's additional things like assignment rights. Let's say you want to sell your
Mhm.
business. Can you assign that lease to another entity if it's through a business sale? What if it's not through a business sale and you're closing? How do you get out of that lease? So assignment provisions are very important. Um, the right of first refusal. If the property is sold by the investor, let's say in 15 years, your situation changes and you really love this location and you want it back. You want to have a right of first refusal in your lease
Ah,
so you have flexibility. Most tenants don't exercise them because they wouldn't have done a sale leaseback in the first place, right? If they wanted the real estate to begin with, but you don't know what's going to happen down the line. So give yourself options and flexibility. And there's more, but those are just some
yeah,
of the big things that the quality of your lease and the provisions are very important. So you don't want to really attempt this on your own. You want someone to
got it.
help you structure it.
That's very helpful. And so, we've got a marriage here. We've got a buyer, we've got a seller, right? Like we got two that it takes two to tango. How do these transactions normally come about? I mean, like, do you find that um, you normally have buyers that are kind of waiting in the wing? You have certain investors that love this type of investment, and so that when you actually have a company or corporation that looks to consider going down this path, you know who the right fit might be from a buyer perspective. I mean, does it tend to happen like that, or is this more of a company looking to maybe access their equity, looking to do on these sale leasebacks, goes out into the open marketplace, and then basically just wait and see what buyers come out of the woodwork? I mean, how do these normally play out?
Definitely not wait and see. We have it all mapped out by industry.
Okay,
So
okay,
there are buyers that just buy car dealerships, which we've done a ton of sale leasebacks in that industry. Buyers that just buy industrial, buyers that like medical and retail. And there's kind of a shoe for every foot for these
okay.
different types of deals. So when an occupier comes to us and says we're thinking about this, what might the buyer pool look like? We can usually give them a clear idea whether it's going to be a private buyer, maybe a high net worth individual or a family office, or is it going to be an institutional buyer that just has funds of these types of sale leasebacks? Um, Buyers really like sale leasebacks because they have some buy-in or some say in the lease structure. Because along with the contract, the lease gets negotiated at the same time, simultaneously. So
Mhm.
unlike a stabilized net lease property where you're buying something subject to an in-place lease, which is also great for different reasons, on sale leasebacks, you can negotiate that lease as well. So if there are
Got
certain
it.
provisions as a buyer that are very important to you, you need a 20-year base term. You must have 3% annual increases. You can try to get those through the negotiation process and create a deal that really works well for both sides at the end.
Good. I'm assuming on the buyer side, again, this buyer pool that you guys have, is there a certain, credit risk profile? Does it fall in different buckets of what type of great investment or I guess what great tenant that they're looking for?
Yeah, you nailed it. So the credit of the tenant is a huge driver of sale leasebacks, and that will be a big determining factor along with asset type for who the buyer pool is. So it could be a small dermatology practice, right? And they only have one location. Maybe you're looking at a personal guarantee on the lease to improve the credit, but that's a private credit or non-credit deal all the
Hmm.
way up to a Walmart distribution center with some of
Yeah.
the top rated credit, that exists in our market, backing your lease. So the resulting cap rates and yields that will be offered on deals on sale leasebacks does have a lot to do with the credit of the tenant.
How wide of a range could we be talking about? I mean, are we talking maybe like on the low end, like 4%, double, low double digits? Could it be that wide?
Yeah, it's a pretty wide range again
Okay.
because there's so many factors. It's tenant credit, it's lease duration, it's location of the real
Hmm.
estate. So, all these different things kind of come together. But yeah, on the very aggressive side, if you have a very sought after industrial property with an investment grade credit tenant, you could be in the high fours, low fives for sure.
Okay.
And if you have private credit that the example I gave you, not a very strong guarantee or maybe one unit probably not going to get all the way to double digits, but you could be in that 8% cap rate range.
How about situations? Is it common to see situations where maybe good piece of real estate, but the company's having challenges, cash flow challenges. They need an infusion of capital, and they haven't been able to get it from other sources, and so they resort to doing a sale leaseback. However, they're not don't have strong credit, and so they're a little bit of a risk to a buyer, or potentially a huge risk to a buyer coming in. How about those transactions? Do they play out?
They're very hard. We get
Okay.
asked that a lot. That's an excellent question because sale leasebacks are such a great way to raise money. But again, you have to look at the durability of the cash flow. That's what the investor on the
Yeah.
opposite side of the deal is looking for. So if a company is facing bankruptcy or they have very difficult debt coming due that they're having trouble refinancing, and this is kind of their takeout of their debt, those deals can still trade, but then you're looking at, is this rent replaceable? If
Yeah.
my tenant vacates in 2 years, can I backfill them and still be okay? And
Yeah.
maybe as an investor, you're structuring a shorter sale leaseback. You're not going to give this tenant that you're unsure of control for 40 years, right? You're going to give them control for 5 years, maybe with one option, and just kind of pull back the reins a little bit
Hmm.
and have a backup plan. So, yes, less buyers and a little more challenging and definitely higher yield to the investor.
And I can see, I guess, worst case scenario from a buyer standpoint is just basically valuing that building as though it's empty, right? I mean, just paying whatever the empty structural value, including the land basis, like whatever that value is, maybe that becomes your comfort level. Is
Yeah,
that is that
there'll always be value above land value because there is
yeah,
cash flow as part of the sale
yeah,
leaseback, but
yeah.
how that's analyzed does depend on the credit of the tenant. You might, if you're very unsure, you might do a net present value of a few years of cash flow and kind of add that on to the land value instead of making it a straight cap rate deal. So there will be some consideration for income in the lease, but how much does depend on the scenario.
Yeah, how are banks feeling about, I guess again, it's a that's a loaded question because there's such a wide spectrum of credit. But I mean, just generally speaking, I'm sure banks like these structures. Is it hard to get lending or debt on these types of deals?
It's no easier or harder than any net lease deal or any deal that's
Yeah.
subject to a lease in place. It again comes down to the lease term and the credit of the tenant and whether that's
Hmm.
already in place at the time of transaction or it's a sale leaseback. It's really kind of neutral from the lender perspective. So there are banks that most banks love durable cash flow with long-term leases and investment grade credit tenants. Those are
Hmm.
the easiest to finance. Now, what we're
Sure.
bumping into right now is a little bit of dislocation with interest rates and cap rates. So those three things I just told you would yield a very competitive low cap rate deal, but interest rates are still above six. So you could have some negative leverage, which would be the challenge in financing
Mm.
that kind of deal. Not that a bank wouldn't love to finance a Walmart distribution center, going back to our
Yeah.
first example, but the numbers aren't going to be that easy to pencil. So it's likely going to be a buyer that does not need traditional financing, maybe a
Yeah.
REIT or an institution.
What does transactional volume look like over the last couple of years with the debt markets where they've been at? I mean, slowed down quite a bit.
Very painful.
Yeah.
It's been a rough few years because of that dislocation between cap rates and interest rates.
Hmm.
Also, private equity has been pretty quiet, and that's historically a big driver of sale leasebacks, right? Private
Hmm.
equity will buy a company and then spin off the real estate to raise funds. It's a classic model. So if
Yep.
the PE firms are quiet, then we don't have as many sale leasebacks. Private companies have been doing less sale leasebacks as well, just because the interest rates and cap rates have been high. So it's been a little bit quieter overall. But now that we have some more debt maturities coming due, we're finding more companies that need to deal with their debt. And so to
Mm.
your point, they're looking at sale leasebacks as an option to take out debt instead of going back to traditional financing because rates are high.
Yeah. I guess what advice would you give someone that's tuning in here? They've got some capital they like to deploy. They like diversity. They like the idea of looking at potentially investing in one or more, of these sale leaseback strategies or structures. How do you find them? I mean, where's the best place to source?
They're typically marketed along with any other type of
Okay.
real estate investment. You can speak to brokers that specialize in them. Happy to point people in the right direction. I
Okay.
would start by looking at an asset class that you're familiar with, you feel comfortable with, and you like.
Hmm.
Is that industrial, medical, office? And then whether it's a sale leaseback or it's a stabilized deal, I would evaluate similarly, right? What's the minimum lease term that you're looking for? What's the minimum yield that you need? What credit profile? Are you a value add investor willing to take on a little more risk? Are you looking for something stabilized, very low risk in your retirement years? Just kind of get clear on what your needs are. And then you can start kind of poking around the market looking for the right opportunities. Scale and size will be a huge differentiator between different asset types as well.
Hmm.
So a retail deal will typically be less expensive than an industrial deal or a manufacturing deal, just because the scale of the businesses in the building. So that kind of factors into what you're looking for as well.
Okay. Oh, fantastic. Well, Carly, this has been a fun conversation. For those that want to learn more, that want to get in contact with you, dive a little deeper, where's the best place to track you down?
I think if you just Google Carly Iacono, Iacono, you will find all different forms of media, but cell phone, email, carly.iacono@cbre.com is an easy one as well.
In your podcast, do you have a dedicated website for that?
Commercial Real Estate Now. It's hosted on YouTube
All
and can be
right.
found on Apple and Spotify. And feel free to link on LinkedIn. Happy to help anybody who has questions and point you in the right direction.
All righty. Well, fantastic. Well, Carly, thanks for joining us here today.
Thanks so much for having me. It's been fun. Appreciate it.
All righty, guys. That's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bubb, wishing you huge success. Take care now.